Welcome back to Trading Hour on CNBC-TV18. Now, shifting focus to the global macros. Now, credit rating agency Fitch has sharply lowered its forecast for global growth as escalating trade tensions weigh down on the growth prospects. They have slashed the world growth in 2025 by 0.4 percentage points and China and US growth by 0.5 percentage points versus their March global economic outlook, which was much higher. So, to discuss all of this, what is the indication that they're picking up further as well? We have Brian Coulton from Fitch Ratings joining in with us to talk to us about that now. Brian, good morning. Thank you so much for joining in with us on the show. I just want to start by talking about the cuts that you all have given so far. What is the worst case scenario? Is this the worst case scenario? And if negotiations that, many countries are having with the US, if that goes through, then what is the upside also from this that we could see? If you could tell me both the parts of the story.
Yeah, I don't think we're so focused on the upside at the moment, really. I mean, what's transpired in the last 6 weeks has kind of been worse than most people's worst case scenarios as of like 3 months ago. So we just need to bear that in mind. I mean, we're at this 10% rate now on the reciprocal tariffs have been moved down to the 10% floor, but that's only temporary, remember? So there's got to be progress within the 90-day window for those not to revert to something higher. Now, hopefully there will be some progress, but that is ahead. Trump has also talked pretty explicitly about new sector tariffs that are coming down the pipe on pharma and semiconductors. So those weren't part of the Rose Garden announcements, but they are to come. I think where we're currently at extreme levels, where probably over the next 12 to 18 months we'll see some improvement, is the rates that we've now reached on China, which are just spectacular. This 145%. That's the sort of tariff bill that's going to completely disrupt trade, and I think the US has now come around to the view that maybe that all got a bit out of hand in terms of the escalation, and that's going to cause some real damage. So I think there is some prospects for coming back from these extreme levels on China, but nowhere near where we were before. We're assuming in our forecast that rate comes back, but only to about 60% on China.
So what are the global growth numbers now? If you could give that for the, on the whole, how has it changed after what we've heard so far on the tariff front, and even for the key economies like US, China, the Eurozone, and throw in India as well?
Yeah, so the backdrop is the world economies did pretty well in 2023, 2024, right? We had global growth of about 2.9% last year. That's above the long run trend. But with our latest revision, we're now seeing global growth fall to 1.9% this year. So below 2 is a pretty weak number. If you exclude the pandemic, the last time world growth was below 2 was in 2009. So we've got Chinese growth falling to just below 4% this year from 5% last year. US growth from about 2.8 to just 1.2 on average, and through the year in the US, Q4 on Q4, year on year, we've got that a point at 0.4, and then the Eurozone, has really been struggling since the Russia-Ukraine gas crisis. It's just been kind of like trundling along at rates below 1%, and we've got growth slowing to about 0.6, 0.7 this year from 0.9 last year. So India is still a global standout, with rates 6.5% range. We don't see it being as affected, but there is going to be some negative impact on India as well.
There will be some negative impact, but for India, but not as much as other EMs is what you're talking about. What about the flows into EMs overall as well? Do you think that could maybe see a bit of a shift or a pause on that front as well?
Well, this is definitely a risk-off environment that we're in now with this global trade war. So all else equal, that would be negative. We are looking at lower global growth. We're looking at lower Chinese growth. We're looking at lower commodity prices, and all those things historically have been associated with weaker capital flows to emerging markets. On the other hand, we have seen some recent weakening of the dollar, which tends to be a bit more supportive of emerging markets. So I think net I wouldn't say this is positive for EM capital flows, but it could be worse.
You said US growth to slow down to 1.2% in 2025, which compares with 2.8% last year. Did I get the numbers right?
Yeah.
So that's a very sharp slowdown, and yet you don't expect the Fed to act very soon and with deep rate cuts.
Yeah, I mean, that's quite a striking feature of these revisions. You know, we slashed our US growth forecast, but we stuck with our view that the Fed would have to wait until the fourth quarter of this year before they were going to cut rates. And that's really all about the adverse supply shock implications of this tariff hike, which will push up prices in the US and restrict supply. And that's on the figuring that we've done. We've got the US inflation rate heading up above 4% by the end of the year. We've got a 4.3% number for December for US CPI. So that's taking the Fed a lot further away from where they want to be on inflation. They hadn't got inflation all the way back down to 2%. It's going to be moving sharply in the wrong direction. And then separate to that, which is also very relevant for the Fed, has been this jump in household sector inflation expectations, which is a real threat to Fed credibility. And we think in the context of all that, even though the Fed will be lowering their growth forecasts in the next meeting as they digest the impact of the tariffs, we think that they're going to be cautious and cutting rates too soon, and so we'll kind of hang on, keep rates at the restrictive level until the fourth quarter. So yeah, it's not a great combination when growth is deteriorating, but you can't cut rates.
Absolutely, that is what everyone will be keeping an eye out on when not seeing much growth. Fed is not cutting rates as well. But Brian, when I'm just talking about Asian countries, specifically, they have a higher exposure, right, in terms of exports to the United States. And that is why these trade talks which are going on are key for them. But how do you see overall EMs in terms of performing, specifically with higher exposure, something like a Vietnam versus China and India? Do you think Vietnam would maybe have an upper hand, or if trade talks, what do you see that in moving in terms of that?
I think it's got to be complicated because, one of the things that happened in the first US-China trade war was this trade diversion, because it was just between the US and China, it became profitable for firms to sort of redirect their export and supply chains, through other countries. But the US administration is kind of all over that, and they don't want to see that happen again. So it's going to make that trade diversion, which did certainly benefit some countries, and Vietnam was definitely in the list there, and Mexico as well, but also other countries in Asia. It's got that trade diversion, which was a benefit. The China +1 strategy as well that we've heard a lot about. It's going to be a lot more complicated in this context because it's such a broad-based increase in US tariffs.
So, Brian, just to circle back, right, the numbers that you've shared with us in terms of the global growth forecasts, this is assuming what base case is tariff? On China, I think you said 60%. Is that correct?
No, we're assuming that the effective rate we think at the moment is about 100% once you account for the carve-outs, electronics and other stuff. We think it's going to remain around that level for some time, for quite a few months. And then it's going to come down to 60%. That's the assumption we're making. It's going to come down to 60% by the end of this year, start of 2026. For the rest of the world, we're just assuming something like 15% average tariff rate.
Okay, so China starts with 100%, comes down to 60%, and for the rest of the world, the base case tariffs should settle on an average of about 15%.
Yep.
And the global growth assumptions are based on that.
Yes, yeah.
Got that. Brian, pleasure speaking with you. Look forward to more conversations. Thank you once again for joining in and sharing your insight. Well, we'll slip into a break. On the other side, we'll discuss market fundamentals. Anirudh Garg from Inva Asset PMS joins in.